Welcome to the Old Capital Real Estate Investing Podcast with Michael Becker and Paul Peebles. During this program, you will hear interviews with real-life successful investors who will share their stories and provide useful advice on how to acquire, finance, and operate apartment complexes. Now, here they are, Michael Becker and Paul Peebles.
Welcome to the Old Capital Real Estate Investing Podcast. I'm your host, Paul Peebles, National Underwriter for Old Capital. And joining me today is the man himself, the mayor, the governor of Beckerville, Mr. Michael Becker.
Hey, Paul.
How are you, buddy?
Doing good.
Thanks for being on your own podcast.
I'm glad to be here for once. It's good.
Also joining me today, the professor himself, Mr. James Eng. Hello, Dr. Eng. How are you?
Great. Thanks a lot, Paul.
So James is also with Old Capital. Michael, of course, is with SPI. What's going on in the Old Capital world these days, James?
We definitely just came off of a pretty large conference. So we had probably 700 plus investors over at AT&T Stadium. So appreciate everyone coming out for that event. And we also put together a couple of webinars, 101 to 303, just sort of on the nuts and bolts of financing. So if you haven't seen that, go to oldcapitalpodcast.com, oldcapitalpodcast.com, and check those out.
You would definitely like that. James did, they're probably about 45 minutes to an hour webcasts, and it kind of goes into the nuts and bolts of understanding financing, how it actually is done and what's important, what to pay attention to. Whether you do your transaction with Old Capital or you do it with somebody else, at least you have some of the background information that you definitely want to understand. Also, to James, Michael, and myself, we wrote a 17-page white paper report on multifamily finance. Make sure you go to Old Capital Podcast, download that. We'd love to have you take a look at it. If there's any questions on that, send us an email on that. We would appreciate that too. Also, don't forget two things. Like us on Facebook. Like us on Facebook. We would love to develop a conversation with you, perhaps about showing you a little bit about what we do for financing on multifamily properties throughout the United States. And if you have more time in your day, go to iTunes and make sure you give us a 5-star thumbs up on iTunes. So, and maybe a comment or two if you thought the information was valuable that we kind of share with you and on the podcast. So in the podcast today, we're going to talk a little bit about Self Directed IRA. Self Directed IRA. And we have Rebecca Miller that's come into the podcast from Quest IRA. They're based in the Texas marketplace. They service throughout the United States. But we're going to kind of get some basic understanding about self-directed IRAs. If you're thinking about getting into multifamily, one of the biggest things that you need is money. And Quest IRA is a self-directed group, and they're going to kind of help you, give you some background where you can get some equity or where your investors can help put their money at to get it pushed into your deal if that works for you. So today we're going to be learning a little bit more about Quest IRA, some of the rules for self-directed 401ks, self-directed IRAs, and some of the rules about what you need to know, what your investors need to know when you're out there talking about trying to raise equity. And so, James, I'm going to throw it over to you. But again, Rebecca, thanks for being on the podcast.
Oh, thank you for inviting me.
So, Rebecca, the two angles that I want to take on this podcast are really just from the general partner standpoint in terms of raising equity and how to accept funds from self-directed IRAs, but then also from the LP or limited partner standpoint, why they should be in self-directed IRAs. And so just to get us going, maybe give us a little bit of your background and then Quest IRA's background.
Oh, got it. So Quest IRA started in the early 2000s with our president, that's H. Quincy Long. And Quincy has grown this company from when I started back in 2009 from 10 employees to well over 100 these days. And, well, the growth has been ecstatic. We have about 17,000 clients, let me check. It was about $3 billion under assets or management last I checked. And right now, you wouldn't believe how much cash is literally sitting undirected. And just our cash accounts alone, we have about $400 million just sitting in undirected cash for folks that are probably actively looking for investments. The reason that they're probably so active is really because we actually pay 0% interest. It's a non-interest-bearing cash account, and so they are actively looking for investments more than likely while that cash is sitting there. Overall, when you look at self-directed accounts, there's literally trillions of dollars about 26 trillion in 401ks and IRAs out there. And a really small percentage of that's actually self-directed right now. Only about 4% of those trillions of dollars is being self-directed through IRAs or 401k plans, actually.
Okay, and then tell me a little bit about, I guess, what do you do?
Oh, right. So I've actually been with Quest IRA. I am their special accounts director. So that means I get to work as an IRA specialist, just generally helping educate our clients, doing presentations at our office, and also just working with customer service when it comes to a lot of our specialty accounts. When it comes to specialty accounts, that really means that I get to work with not only our solo 401k holders, because about 1% of our entire clientele work with a solo 401k because of the requirements and special aspects that come with that account type for self-employed individuals, but also I get to work with the unfortunate passing of an account holder and moving assets into their beneficiaries' names as well.
Okay, so let's maybe start from the LP or limited partner standpoint. They're working at, let's say, GE. They leave GE, now they have $200,000 or $300,000 in a retirement account, 401k, and now they have the option. They're looking at investing in real estate. How do they go about, or why would they move it from a Fidelity account to a self-directed account?
So if they're looking to really make a private investment, they'd have to work with a self-directed IRA custodian that could hold those private shares of stock, for instance, or buy real estate or invest into loans, you name it. And so they'd have to move usually just what they would need into a self-directed account. Okay. A lot of our clients will actually work with more than one custodian. Usually a brokerage firm like Fidelity will hold the remainder of their funds in publicly traded assets or even a money market. So it's gaining some type of interest and actively working. And they'll bring over to us what they'd like to use for their non-traditional investments. The movement of funds process, we tried to make as streamlined as possible by tracking what different banks need. Because you can only imagine that every single bank has its own policy or procedure for what they require to transfer money out or to roll money over. And we do our best to keep track of, those big boys out there and what they generally require, or to even follow up and learn more about where our clients are transferring their money from or rolling their money over from, so that we can best instruct them on what we'll need to initiate that movement of funds right the first time around.
If, let's say, I call you today and say, I want to move over $100,000, how long does it take to go from Fidelity or any of these brokerage accounts over to Quest IRA, and then what is the cost to me as a limited partner or just somebody who's moving it over?
So Fidelity is a great example. They move money fairly quickly, and compared as an average, I'd say they take about 2 to 3 days once they receive a faxed transfer form from us to send out either the check or the wire. So I actually had a client move over $1 million from Fidelity this week. We initiated the transfer on Monday. We literally had a wire in hand on Tuesday, so they really met like a 2-day turnaround time on their side, getting that wire out to us, and he was ready to fund an investment by Wednesday.
So on that $1 million, I guess, is there just a setup fee or is it a monthly fee? How do you guys charge the person?
How does Quest make its money?
Or just a general idea of is it the limited partner who's putting in a fee to you guys or paying a fee? How does that work?
So as far as the transfer goes, as far as moving money, the company that's transferring money out may have a fee. I don't believe Fidelity does. I do know that they have a wire fee, though. I want to say it's either $20 or $30 from my memory.
Okay.
But beyond that, when it comes to Quest IRA's fees, we have a $100 account opening fee. Okay. And then when we process an investment out of the account, it's a $125 asset purchase fee, plus a $5 check to send a check out, or a $30 wire if they'd like a wire sent. And last but not least, there's an ongoing administration fee to hold the asset in the account. Okay. It's about $295 a year.
Okay. All right, great. And so as people, so you said there's, a lot of money sitting in self-directed accounts. A lot of our clients, a lot of people listening to this podcast are general partners. Mm-hmm. And so they're out raising equity for syndications. And how does that process work for a general partner? How do general partners work with you? Or let's say that guy who transferred $1 million, let's say this week he wants to invest $100,000.
Well, actually, this is a great example because that's exactly what he moved over $1 million for. In this instance, there was another company that actually offices near ours, so he had no problem actually bringing in a client into my office, sitting down with me, introducing me, and basically I walked him through the paperwork, took no time at all, and from there, the processing went really smoothly. But as far as the process for getting started for just anybody who's not a couple of yards from our office, usually a call or email introduction works so well because it helps to have our expertise there to walk them through the process of moving funds. Because when somebody tries to figure out exactly what their bank needs to move funds over themselves, they're figuring it out for the first time. It'll take longer, it'll take a little bit of frustration on their part, but if we could walk them through it using our knowledge and our expertise, it can really streamline the process and make it entirely headache-free for not only the capital company, but also for the investor.
Okay. Yeah. I think I went too fast there for a second. So with the LPs, maybe touch on some of the advantages on the self-directed. So if somebody was, instead of rolling it over to a self-directed IRA, they just pulled the money out of the IRA and took it to cash and invested. When people say that scenario to you, what's the best sort of answer to that? Like, instead of paying taxes on it now, but I'm going to roll it into a self-directed IRA, is there a good...
Well, one of the best benefits, of course, is that you're keeping the tax benefits in the account and not paying any penalties. If someone was below the age of 59 and a half and tried to cash out their 401k or their IRA to make this investment, if they were below 59 and a half, there would be a 10% penalty, as well as they could be adding a lot of money to their taxable modified adjusted gross income that year.
Okay.
That could be very disappointing, as well as if the money came directly from a 401k. On 401k or employer plan distributions, the company cutting the check essentially, or bank, is required to withhold 20%. So you actually only get 80% if you go directly from an employer plan to the plan participant, to the account holder, instead of going to an IRA. So there's a lot of benefits of A, you can keep all of your money by moving it into an IRA. B, you don't have the taxation problem. And then C, you can still do the same exact investments using a self-directed IRA.
Okay. Are there any other rules that people should be aware of in terms of, if you move it into a self-directed IRA, can you buy your own deal? Or does it have to go into, so that person who moved the $1 million over, can he go out and buy his own 50-unit deal here in Dallas? Or does he have to invest with somebody else?
That is a great question. So there are some restrictions that we'll touch on here first, but before I jump into those, or actually those are probably a good point to start off with. So there are some investment restrictions with self-directed IRAs in general. Ever since IRAs were created, these great accounts offered a fantastic tax benefit that the IRS didn't want you to reap the benefit of until you retired and took a distribution. And so that's why we see penalties if we try to take the money out early, but that's also why we see some investment restrictions when it comes to investing our accounts. These restrictions are called prohibited transaction restrictions that keep the IRA owner and their direct family members who may inherit their account, like a spouse, a child, grandchild, parent, so a lineal ascendant or descendant, as well as their spouses or any companies they own, control, or manage, in general, are disqualified from entering into a transaction with the IRA owner's IRA. And that's to keep the IRA owner from receiving an early benefit to themselves or the beneficiaries that could inherit their account at an early date. So when you mentioned investing into like your own project, that was a bit of a red flag for me that it could be seen as a prohibited transaction. When you look at just buying real estate, however, or a multifamily investment complex directly versus trying to invest into something that you already owned or acquired, that's a little bit different. And so we could look at that a little bit more too if you'd like.
So basically meaning that if I'm a sponsor of a deal and I have $100,000 in my self-directed IRA, and the way I understand it, being a layman in this industry, but if I'm raising money and I'm going to get paid some sort of compensation at the project level for being the sponsor of the deal, I cannot invest in my own deal without being a prohibited transaction. Is that
That's
accurate?
correct, because there'd be a very clear benefit going to you via your compensation and personal connection to that project and business.
Yeah, so that's not only for me, it's for my spouse, my parents, my children, or any of their spouses, correct?
Correct. They all have a beneficial interest in your IRA, so they're disqualified as well.
So that the client who brought in $1 million, they say, I want to move the money over to a deal, 100,000 into a new deal this week. Does the general partner provide you information? Does the limited partner provide you information? How does that work to make sure they're not breaking any of the government's rules?
So, of course, we require certain investment paperwork in order to process a investment out of the account. For capital investment, that's usually a subscription or operating agreement. On those, we can clearly see who the owner of the company is, the signer, essentially, for the company. If it's clearly somebody who could be listed as a beneficiary or even the account owner, we will be unable to process the investment because it's very clearly flagged as a prohibited transaction, and we'd literally be unable to process it.
So you get those documents, let's say today. How long does it take for you to actually review all that stuff and then get the wire out to the, let's say, general partnership's account or the borrower's account that's buying the property?
Because we really train our employees to have a quick turnaround time, it's only 24 to 48 hours with us with no expediting fees.
Okay. Wow. And then in terms of, as a platform, how would you say Quest IRA differentiates itself from other self-directed IRA platforms?
It's one of my favorite questions. The first answer is that we're amazing.
Perfect.
Just kidding. But no, really, we have a really highly trained staff. In fact, right now at this very moment, we have 10 of our employees, IRA specialists, transactions managers. They're all in Chicago taking a certification test to become IRA services professionals. This is the highest level of education that we provide our employees to get them really certified as IRA specialists. But quite truly, that also goes even lower. We have 11, 15 trainings every day. And so we provide a very high level of customer service because of the education that we train our employees with. But also, I mentioned already, the quick turnaround time. I've seen, folks who were given a misunderstanding on what they needed or didn't get their transfers processed in time, miss an investment and come to us because they were already frustrated with their current IRA custodian, even though they hadn't even made an investment yet. And so that knowledge and background really helps contribute to the customer service. And then, well, we're based here in Texas, so if you're a Texan too, that's another reason to choose Quest IRA. But we really work with everybody across the nation and provide the same quick turnaround time as well.
Yeah, let's go back to those prohibited transactions. One of the things that we come across on the lending side is we take a look at somebody's personal financial statement. We have the assets in the top, liabilities in the bottom, and the assets. Some people keep cash, some people keep their IRAs in it. And they say, I want to buy a property and I want to buy it myself and I want to use my IRA as cash in the deal. And I kind of have to stop them right there because sometimes some of the regional banks will allow them to use their IRA funds into the deal. What I try to tell them and make sure that they understand, it's not that so much the bank is going to be the gatekeeper, it is going to be Uncle Sam. It's going to show as a prohibited transaction down the road. So you cannot really typically use your personal funds or your IRA funds into the deal. Now, there are some non-recourse lenders that will use self-directed IRAs if it's low leverage into the deal too. Have you seen that at all?
Oh yeah, we actually provide a list of companies that we know specialize in non-recourse loans to our clients if they're trying to do non-traditional financing, getting a non-recourse loan and don't know who to approach about it because not every bank does non-recourse lending.
You typically see a non-recourse self-directed IRA lender, their leverage is 55% probably max and that type of stuff. They typically like single family. They're not too crazy typically about multifamily, but they will do it in some specific cases too. But most of our guys that are apartment buyers, they're looking to get equity from some individuals that want to invest into real estate, into these deals. Is there anything that we need to know if someone's coming in and investing into these deals? Again, individuals putting money into these transactions. What are some of the, other things that we need to know?
So one of the major aspects to be aware of if they're IRA investors that are investing to make that capital is that the investment itself could create a tax called unrelated business income tax, or UBIT. This is a tax that's generated by two types of investments: debt-financed real estate or purchasing and owning shares of a business that's passing through taxation to the shareholders. And so in that instance, especially because of the debt leveraging, for instance, it could create unrelated business income tax. And it's just important for the IRA owner to be aware of that. That way they can consult with their CPA or tax advisor and understand the expense.
And so one of the things I've heard before is that UBIT is more likely to happen on a self-directed IRA and that you're exempt from UBIT if you have a solo 401k or self-directed 401k. Is that accurate?
That's mostly accurate. 401ks are really well known for having a exemption on unrelated business income tax, but more specifically, a branch of it that relates to debt-financed real estate. So the exemption is really supposed to apply towards owning a real estate with a loan against it for a year or more to avoid being seen as a dealer. But it can possibly apply to some of those like multifamily investments out there. What we have to do is that we highly encourage consulting with a very knowledgeable CPA or a tax attorney to really review the exemption and make sure it applies to your investment if you're looking to use a solo 401k for it.
Mike, you guys raise money, you buy apartment buildings. Do you guys raise 100% of your money from self-directed IRAs?
No.
Why or why not?
Yeah, so when we're out raising capital, I think probably somewhere in the 20-ish% range is probably about what we tend to get on most of our transactions from self-directed IRA or solo 401ks. That tends to be about what we do, and a lot of our investors have used Quest, and I would give her a little commercial here. They've been amongst the most easy transactions from the sponsor side to deal with. They're always timely and turn stuff around and seem to understand it, where you work with some of these other companies that tend, I think they just tend to do where people buy their own single family house, and that's kind of what they're set up to, and they're not as set up for these syndications. So I think there is definitely some differentiation across providers in the marketplace, but it seems to be a pretty good avenue, Paul, to tap for a sponsor who's looking to go out and get some equity. Some of the things that we haven't quite brought up from a sponsor standpoint is, on an annual basis, all the IRS requires, and when you're taking this capital, you as a sponsor has to sign off on a form for all the self-directed IRA companies. You have to provide an FMV form or fair market value form on an annual basis. We're typically doing ours in January. And that's basically kind of gives an update so the IRA holder can, provide notice to the IRS how much the asset is worth at that given time. So, as you scale your company up and as you do more and more of these things, if you have many different investors and many different self-directed IRA companies that they work with, you have to get a process in place to kind of work through that. So I don't know if there's anything you want to add to that, Rebecca.
Oh, there certainly is. I know that we've been chasing IRA and 401k holders for almost a year now, collecting 2017 valuations. And last I heard, we had almost 94% turn-in rate because, we did a lot of follow-up to get those fair market valuations, as well as we'll even just do it for you if you pay us a $50 fee, actually, if we can anyways.
So, Mike, let's say somebody invests in your deal and it's through a 401k and you send them a distribution that goes to you guys, Rebecca, and it hits their account.
Their IRA, yes.
Yeah. Does that money stay there, or can they pull it out, or does it have to stay in there?
So the cash would come into the IRA account, and the account holder could then choose to, put together investment paperwork for us to process an investment, or they may choose to take a distribution, in which case there's just a distribution form if they needed to take something out for either their minimum required distributions if they're over 70 and a half and that type of thing.
Okay, so on this, if they're under 59 and a half, if they take it out, do they pay ordinary? They pay the taxes on it at that point?
If they're below 59 and a half, there's again that 10% penalty.
Okay.
And then the account, if it's tax deferred like a traditional IRA or SEP or simple, that would also be taxable to the IRA owner.
Okay.
Yeah, I think, and back to the FMVs, those are only required on self-directed IRAs, not solo 401ks. Is that accurate?
That's incorrect.
It's incorrect.
So, for instance, I do our 401k consultations, and I talk about in those consultations the importance of record keeping and IRS reporting. So, when it comes to record keeping, it doesn't mean just recording every transaction like buying and selling assets. It would also be documenting the value of your investments each year. Why is that so important? Well, for instance, once your account exceeds $250,000 as a value, you have to start reporting annually to the IRS what the value of your account is. Do you think it'd be accurate if you didn't have a documented value for what you used to show that market value that year? No. So yes, I actually can encourage fair market valuations for yourself. And we actually send the same letter to our 401k holders. So I'd always tell them to use it as a reminder to do your own.
Is that a standard thing in the industry, do you know, or is that just unique to Quest with the form for the FMVs for the solo 401ks?
So our solo 401k holders actually get to act as their own administrator and custodians. So they're literally responsible themselves for not only doing that IRS reporting, but also for doing their own record keeping. So I encourage them to collect their own documentation themselves. They don't have to turn in a form to us, but they may document in their own bookkeeping how they came about with the value that they may use for their own reporting purposes.
So that's why I thought that, because no one ever asked for it, because no one's making them do it.
That's exactly correct.
So then that's a question. So some of the distinctions between if you have a self-directed IRA account versus solo 401k account, you say they get to act as their own administrator. So do they have control of the money and can do their own banking, or is that still held with you guys?
No, our solo 401k holders get to do it all themselves. So they do get to hold a checking account, and that requires them to really do their own bookkeeping and record keeping, like I mentioned.
So what is the benefits between a self-directed IRA and a solo 401k?
Yeah, tell me what pros and cons.
Tell me why I would do one versus the other.
That's my entire consultation right there. I'll give you the bullet points.
There you go.
The benefits that a solo 401k can offer you over a self-directed IRA are that you can contribute more of your self-employment income to a 401k account than you could to any other account. And there's also Roth 401k components as well as traditional 401k components, so you can really reap those tax benefits on contributions. But also we talked about the exemption to unrelated business income tax, UBIT, as well as a third benefit would be how you can actually take a loan to yourself for up to $50,000 or half of the account's value, not to exceed that $50,000 as a maximum. And last but not least, the checkbook control is really sought after by a lot of investors. I'd say that they probably came from another company that couldn't process in 24 to 48 hours. But other than that, a lot of folks really seek out kind of a little bit of a break on the fees. Where generally with self-directing, like an IRA, you could expect to spend a couple $100 a year. With our 401k plan, we actually just charge like one upfront plan document fee of $1,500. And then you only have to pay us again when we have to rewrite the plan documents every 6 years. It ends up being cheaper to have a solo 401k as far as our fees go than it would be for a self-directed IRA. But you can imagine how much work you're putting in because there's a lot of responsibilities. This is kind of the cons of a solo 401k is the responsibilities that come with it. You have prohibited transactions that you're responsible to keep from doing. There's no company over your shoulder making sure that you're not about to execute an investment agreement or get the wrong type of loan, for instance. And so there's a little bit of risk because you're the only one that can keep yourself from completing a prohibited transaction. That's also kind of a higher point with 401ks, though. A lot of folks like to teach about how 401ks actually have a little bit of a lenient penalty for prohibited transactions instead of a prohibited transaction destroying an account the way it does a IRA, where it essentially requires you to distribute the entire account. With a solo 401k or 401k plan, it only affects the asset when you create a prohibited transaction. So it's kind of a pro and a con when it comes to prohibited transactions. But I mentioned a lot of responsibilities. That includes all the bookkeeping for the different types of money that you have inside the 401k. You have to track the way that you're investing your contributions separately from the way that you're investing your rollovers, which causes a lot of split bookkeeping. So it takes a lot of work on the bookkeeping aspect or a really good bookkeeper helping you. And then documenting your investments like those fair market valuations and just saving the documents related to what you're investing into. And finally, the IRS reporting. And the worst being of all is actually that solo 401ks have a bit of a higher risk of audit from the IRS. They are the most audited self-directed account in comparison to IRAs or educational savings accounts or even health savings accounts. 401ks are the highest audited self-directed account out there.
Certainly do not like to hear that.
So we're digging in pretty deep here. In terms of maybe training that you guys do, I mean, I'm sure we could be here for a couple hours talking about IRAs, but what is maybe some of the stuff that people just don't know, or going through your training, people are like, that was the number one thing, or one or two things that were like the top things that people are just not aware of in the space?
Prohibited transactions are always a number one thing to touch on, whether somebody's buying real estate or investing into somebody else's company. Making sure that it's not a prohibited transaction and understanding those restrictions is a BINS. That's an easy question to answer every time somebody asks me, what should I know before buying this house in my IRA? And it's always, making sure that they're aware of those prohibited transaction restrictions. And maybe just the timeline for getting set up. Sometimes, especially with capital funds, we'll see where the investment deadline is tomorrow. And you know what? You can't transfer money from another IRA custodian or usually roll over money fast enough for that investment deadline. We highly encourage allowing 2 weeks, while, some companies like Fidelity, they can move money in 2 or 3 days once the account's open. But there's other banks out there that can take 2 or 3 weeks. And so making sure that your investors are aware of that timeline for moving over funds can help you better help them and get the account open in time for your deadlines.
So what can individuals invest in?
Just about anything you can take title to, you can invest in with a self-directed IRA. That's pretty broad, right? That could be
very broad.
Real estate. You could be buying heads of cattle, unimproved land. We even have some clients that invest in wholesaling soy sauce packets or breeding horses. Whatever you're knowledgeable on, you can probably invest in that with your IRA as long as they file the IRS guidelines for those prohibited transactions. There's only 2 things you really can't invest in. So I guess that's the shorter list. The 2 things you're not allowed to invest in beyond those prohibited transaction restrictions are collectibles, like works of art, alcoholic beverage collections, antique cars. These are all really hard to value, and the IRS likes those fair market valuations, and that's why they don't like collectibles. They also don't like life insurance investments because, then your IRA would have a vested interest in somebody's passing. And that's about it as far as the investment restrictions go. So it's actually very, very broad.
Do you guys put on any events or trainings, like if people want to get to know more about sort of you guys and what you do and get comfortable with you guys? Do you guys put on anything here in Dallas or in Houston or throughout Texas?
Absolutely. We're actually about to have one of the biggest parties we have every year. I say party. A lot of our events are actually education oriented. Even this one is. We host weekly classes in all of our offices in Austin, Dallas, and Houston, Texas. So it's a great opportunity to, get some education for an hour, network with other local investors. And then we throw larger events. So for instance, we just had a expo in August where we invited investment experts from across the nation for notes and multifamily and a whole lot more. And we also partner that education for self-directed IRAs alongside that of other tax attorneys in the industry as well. So it is one of our largest educational events, but we also get a little bit more fun. We're about to have Fright Night next week in Houston, Texas, and it's a Halloween-themed event. So all of our clients and all of our employees, they come out in costumes. Not all of them, but most of them come out. They break out their Halloween costumes, and we go really big. We've actually rented something similar to a very large wedding venue with multiple rooms because we have a room for frightening educational presentations from some of our clients. Are going to tell scary investment stories, and they're going to battle for the best investment story. And then there's also going to be like a dance floor and a DJ, and it just so happens to also be open bar. So it will be a great night of laughter and scary investment stories and a little bit of dancing.
Mike, what's your take on self-directed IRAs?
Yeah, I mean, so as far as I'll just do it from the sponsor standpoint because I don't have one personally from my own money, but because I can't invest in my own deals because it's a prohibited transaction. But from, as a tool and the tool belt, it's certainly a very valuable one. Certainly you won't take all your money in from this way, but to have that as an option certainly is extremely helpful. And as I mentioned kind of previously, about somewhere between 20 to 25% of every typical deal we take has some level, either solo 401k or self-directed IRA money in it. So it's a pretty large percentage overall of what we take in. And as she mentioned, there's about 26 trillion or so in retirement funds in the nation. And then only about 4% of that's in self-directed. But if you think about 4% of 26 trillion, that's still a whole lot of money. So I can't quite do that math. Maybe James can. I was in college a little longer than James, not for the right reasons, but that's about $1 trillion probably, give or take, of available capital out there. And as she mentioned, people that tend to invest in solo 401ks and self-directed IRAs tend to be a little bit more entrepreneurial and wanting to put their money out at risk. They're not wanting to stick it in a mutual fund or a bond fund or something like that, like a more traditional Wall Street type investment. So going to that, going to their events, I think would be a great way if you're a sponsor or aspiring sponsor trying to find and network with people that have capital and willing to invest. I'm sure that's a stock pond to go fishing in. If you go put your vampire outfit on and go to Houston, that would probably be a good thing to do. Or any other, I see you guys all around town here in Dallas and Austin and Houston. So you guys tend to have, seemingly is a monthly or quarterly type event. So I would certainly look at them. Then as I mentioned, we probably have, 10 to 15 various self-directed IRA companies that our investors work with, across the nation. And, I think the most are with Quest because they're based here, we're based here, and they tend to be, when anyone's asking us for a referral, that's always the one that I give out because they're the most easy from a sponsor's perspective to work with, and their turnaround time and timeliness is, usually within a day or so. So we certainly have enjoyed our experience with them and would recommend you guys reaching out to Rebecca if you guys have any interest in this and any need. I think, Quest is a first-rate company in my perspective.
Yeah, and I think as a general partner, your ability to articulate some of this stuff to LPs, maybe it's their first deal, maybe it's the first time moving over to self-directed IRA. So if you have a company that you can refer to and you have a little bit of education in the space, that will go a long way in getting people comfortable not only with your deal, but how they get the money into your deal as well.
That's certainly true. We bring, as the lender, we bring 75 to 80% of the debt. You got to go out there, if you're a sponsor, to find the money, and you need to find a partner that you can work with, like Quest, that can help you to build a platform, working with a group like Quest with Rebecca that can kind of huddle your equity investors that are going to use the 401ks to kind of work them through Quest, through Rebecca, to make sure they're set up right. You got to set these deals up right from the beginning to make sure that we don't have any problems on a going forward basis. So if you're looking to, like Mike says, go fish in a stock pond, talk to your self-directed IRA sponsors, and we'll put a plug in for Quest in their next
I
opportunity.
think you guys even have a cruise, if I saw that. Is that right?
Oh, actually, yeah, we're a sponsor of the cruise. It's the Financial Friends Network. You can check them out on financialfriendsnetwork.com. Our president, H. Quincy Long, hosts that event alongside Mr. Walter Wolford, and it is, I think of it like an expo at sea almost, because they have a number of really, really educated financial advisors, tax attorneys, other investment experts, and they do educational presentations while they're out at sea. And then, of course, when you dock, you'll get to escape the boat, run around in the tropics, or we actually just did 2 European cruises, which are a little bit smaller. And they're about to do another tropical one coming up in March, but I heard that one was really close to selling out if it didn't already. But they usually have 3 or 4 lined up a year.
That's great. So if people want to find more information about you and want to have a conversation with you, what's the best way to find information about you, Rebecca?
So if you just visit questira.com, there's a little panel on the side of our website where you can contact an IRA specialist. That goes out to about 16 IRA specialists. Or you can just email IRA specialists at questira.com, and we'll do what we can to take good care of you. And we also have a nice 1-800 number if you'd like that. It's 1-855-FUN-IRAs.
Couldn't think of a better representative to Quest IRA than Rebecca Miller. James, she's a CISP. Do you know what that is?
I don't know what that is, but it sounds really hard to get.
Rebecca, what is a CISP at the bottom of your name?
It's the certification I got from the Institute of Bankers as a IRA services professional. You actually have to have about 2 years in the industry, which I kind of kicked with about 4 when I took mine. Has about a 70% fail rate from what we've grasped. And gotta say, it's a proud certification that we carry for our IRA specialists.
All right, well, that's Rebecca Miller, CISP specialist. We do appreciate you hanging out with us in the podcast. Michael Becker, always a pleasure to see you.
Glad to be here.
James Egg, thanks for coming in. Rebecca Miller, thanks for hanging out. I'm Paul Peebles. Have a great day.
Thanks for listening to the Old Capital Real Estate Investing Podcast. Please join us at oldcapitalpodcast.com to sign up for our weekly email updates. We'll see you next week for another great interview.